Today, I want to talk about why another market crash is inevitable, but more importantly, why you shouldn't be worried about it. In the next few minutes, I'm going to break down why you should always be prepared for market downturns, why investing at all time highs isn't as risky as it seems, and the key reason most investors lose money. If you're new here, I'm Julia, certified financial planner and the managing director of URS Advisory. And to be perfectly clear, this is not investment advice. This is just data and insights to help you think differently about the market. I'm also going to review a couple of ways to take advantage of a down market or a pullback. If this video can help even one person stick to their investment plan, then I've done my job. So let's get into it. Every so often, I make a video specifically on the stock markets, and I think that now is an ideal time to make another. Lately, there's been a lot of fear around the economy and the condition of the world in general, and investor anxiety is growing to a fever pitch. Most recently, the S&P 500 is down 5% off of its peak in February, and no matter how experienced you are as an investor, there are certain blind spots that are costly, both for pre-retirees and retirees alike. I want to be clear that this video is not meant to minimize your anxiety around losing money in your portfolio. Of course, you're going to feel anxious and mad and worried when watch your investments go down. And unfortunately, there's nothing that I can say that's going to take that away. However, you do need to understand how market pullbacks have worked historically and what follows. So I'm going to start by sharing the story of two major market crashes, lessons that could be the key to protecting your retirement plan. Please note that I will be referring to the market as the S&P 500 index throughout this video. Since 1928, the U.S. stock market has delivered an annualized return of nearly 10.5%. That means if you had invested just $1 back then and left it alone, by the end of 2024, it would have grown to over $18,643. But it gets even better. Since 2009, markets have compounded at nearly 15% per year, a rate almost no one on Wall Street could have predicted. Of course, those impressive returns didn't come without a lot of volatility along the way. There have been plenty of sharp declines and moments that tested investors' patience and discipline. And it's those emotional reactions to market downturns that cause many investors to lose money. Today, I want to go beyond the headlines and dive into the actual numbers, giving you concrete data that could change the way you think about investing. Now, we know that over time, markets go up, right? In fact, over the past 100 years, the markets are up nearly 75% of the time. What we don't think about is that markets are often down a significant amount on an intra-year basis. So even if the market is up for the year, it's very likely that there was a large drawdown at some point during that year. Here's an eye-opening statistic. From 1928 to 2024, the market experienced an average intra-year decline of 16.4%. In other words, at some point each year, the market was down by more than 16% on average. Yet, despite these pullbacks, the market still finished the year in positive territory nearly 75% of the time. Here in this chart, we can see that the median positive return per year is 21%, and the median negative return is negative 0.95%. But let's make these numbers a little more relevant to our lifetime, since none of us were investing in 1928. So if we look at the data from 1980, right, all the way up to 2024, the average intra-year drawdown is only 14.2%. But that still means that at some point during the year, the market was down off of its high 14.2%. Since 1980, so 45 years ago, the market has been down 10% or more in over 50% of those years. That means that out of the past 44 years, the market was down by 10% or more intra-year in 23 of those years. So if you were investing and watching the market every day, at some point during 23 of those 44 years, the market experienced a drawdown of 10% or more. And while a 10% decline feels and is significant, it doesn't stop there. From 2000 to 2023, so the past 24-year time frame, the market was down by 10% or more intra-year in 58% of those years. So meaning that in 14 of the 24 years, the market saw a 10% or greater drop at some point. The most recent example of this is 2023. So in 2023, the market was up 24.23%. So that is a, stellar year. However, there were two pullbacks that year that spooked a lot of investors, one just under 10% and one just over 10%. So if we look at that chart between February and mid-March 2023, the market on a closing basis was down almost 8%. This was just around or before the 2023 banking crisis, right? Triggered by the failures of Silicon Valley Bank, Signature Bank, and First Republic Bank. It's worth noting that the day after the failures, the S&P 500 rose almost 17% between March and August of that year. We'll get into common beliefs and mistakes a little later in the video, but okay, later that year, between August and the end of October, the market declined just over 10%, and many were sure that the market didn't have any fuel left in the tank. However, between October 28th and December 31st, the market launched up 14%. And here's more interesting data. Between 2000 and 2023, the market was down by 19% or more in 33% of those years, meaning that 8 of the past 24 years, the market experienced a nearly 20% or greater decline. Now let's bring some more history into these stats. This chart here shows us how normal and frequent market declines are. Looking at the S&P 500 from 1954 to 2024, we can see that about once every 6 years, we see a decline of 20% or more with an average length of 402 days. This last occurred in January of 2022. Of course, this doesn't mean we won't see this again until January of 2028, right? These are just averages. But I bet you didn't realize just how frequent these larger declines actually occur. Speaking of a 20% or greater decline, technically, a bear market is when the market is down 20% or more. But when I ran the data, I found that the market would often decline by 19 or 19.5%, only to reverse sharply and rally back up. So I went ahead and ran the numbers at 19% because whether your portfolio is down by 19 or 20%, it feels exactly the same, right? Bad. And we can see here on this chart again that declines of 15% or more occur about once every 3 years, with the last one being in August of 2022. So let's say that you retired in 2000, 25 years ago, with $1 million in the S&P 500. That means that over the past 25 years, you would have experienced 6 different drawdowns where your portfolio was down by at least $200,000. If you had a $2 million portfolio, at some point it could have been down by over $400,000. And here's the thing. If you retired 25 years ago, your portfolio may have continued to grow, right? You may have started with $1 million, but now maybe it's $1.5 million. A 10% decline on $1.5 million is $150,000. A 20% decline is $300,000. These are painful drawdowns and yet a normal part of long-term investing. And here's why I can almost guarantee that a market crash is coming. I don't know when, right? No one knows. It could be this year. It could be a year from now. It could be 5, 10 years from now. But if you have a 30-plus year retirement, it's not improbable that you will experience 8 to 10 painful market corrections where the market's down by 20% or more. And each one of those is going to feel scary. It will trigger fear, not because you're bad at investing, but because you're human. And here's what happens, particularly once we enter retirement. We panic. We want to stop the bleeding, so we sell at exactly the wrong time. I've seen this with my own family and with clients. Waiting on the sidelines to re-enter the market is one of the hardest decisions you'll have to make, if you end up making it, right? Some end up sitting out for decades. Here's another noteworthy anecdote. Peter Lynch is one of the most famous and most successful active managers of all time. He managed Fidelity's Magellan Fund from 1977 to 1990, and during his tenure, the fund averaged an astounding 29% return per year. That is well above the S&P 500. But here's what was really interesting about that. According to Fidelity, the average Magellan Fund investor lost money during Lynch's tenure. So how does this happen, right? You're looking at the 29% average annual return. You would expect that most people in the portfolio made money. But Lynch had years where he was up big and years where he was down, often more than the market. For example, in 1980, Lynch's fund surged by 70%. But the very next year, he underperformed. So investors who jumped into the fund in 1980 were disappointed when they watched their investment lose money in the years following. And as human nature would have it, they jumped out of the fund looking for another market winner. And by doing so, they had locked in their losses. Had they simply stayed invested for another 10 years, they would have averaged more than 25% per year. Obviously, not every fund manager is Peter Lynch, but this just illustrates the devastating effects our emotions have on our bottom line. If you're losing sleep over your portfolio during a market correction or a bigger pullback, my advice to you is to de-risk a bit on the following bounce. So even in down years, there are several oversold bounces that occur for weeks, sometimes even months. And when those occur, you need to seriously consider de-risking your portfolio. There is absolutely no reason to lose sleep and have crippling anxiety around your investments. And if you do de-risk on a bounce and then the market rallies, right, so we don't go back down, you need to be okay with underperforming as well. You cannot have your cake and eat it too when it comes to the stock market. You cannot base your day-to-day mood or emotions on how your portfolio is doing. It is so important to have realistic expectations around investing. But what can you do during a crash while the market is pulling back or correcting? Instead of selling during or after a crash, we can actually improve our financial situation by doing Roth conversions while the market is down. If you've analyzed your tax situation and know that Roth conversions up to a certain limit will benefit you, again, you need to do, a full analysis on your specific situation, keeping in mind your current tax bracket, capital gains, Medicare IRMA, and more. The best time to execute these conversions is during a market downturn. This is because you'll pay conversion tax on less money. So let's say your traditional IRA was $100,000 and dropped to $70,000 when the market fell. You'd be converting the lower amount. The reason you're converting money to a Roth IRA is to be able to withdraw it later tax-free. Converting when the market is down allows you to convert a larger portion of your account for the same cost. And when the market bounces back, you'll get the tax-free growth on the money you converted. Okay, let's go back to emotional investing decisions. Here's another eye-opening statistic from Dalbar, an organization that studies investor behavior. From 1990 to 2019, the S&P 500 returned nearly 10% per year. But during that same time, the average investor only earned 5% annualized. And no, this is not just because investors were diversified into international stocks or bonds. I ran the numbers for a globally diversified 60-40 portfolio during that same period. It returned 8.72% annually, with significantly less volatility than just the S&P 500 alone. Therefore, during that 30-year period, the S&P averaged nearly 10% per year. A diversified 60-40 portfolio returned 8.72, and still the average investor only made 5% per year. So why is the average investor so bad at investing? Well, there's really only one reason, right? Other than the fact that we as humans make emotional decisions. And that is that we think we can time the market. We either sell at the worst time out of fear, right? Like the Magellan Fund example, or we jump to the next hot thing at exactly the wrong time. For example, we see Nvidia or Tesla skyrocketing, and we can't stand hearing our friends brag about their gains, so we jump into the stock right before it starts a big pullback. So let me use a recent example. Back in December, we had a couple of clients call in because they were curious and they wanted to buy Bitcoin, right? After the second call, I said to myself, this has to be a sell signal. Like these people, that have never mentioned it in their lives are now interested in Bitcoin. And sure enough, 2 months later, Bitcoin pulled back by about 20%. As a financial advisor, I get a great read on sentiment, not just from clients, but from other advisors that I speak to on a regular basis. If the boat is too full to one side, i.e., everybody is starting to feel either invincible or hopeless, our market turn is just around the corner. This chart does an excellent job of illustrating the emotional cycle that unseasoned investors follow. As the stock or index rises, we start to feel like a genius, right? Then greedy, right? Oh, it can't go down and I don't need any help and I'm just going to hold my positions in 100% stock. Then once it starts falling, we deny that things have changed. We ignore that price support is breaking. And by the time it's hit the bottom, you feel so hopeless that you sell. Another reason is trying to time the market based on the news or based on your feelings instead of technical market data. It's one thing to trim and buy with discipline, based on a system, but it's quite another to time the market based on something you've read or just your own anxiety. This manifests as thinking the market feels like the top. So the way I hear it is, stocks are just too high. They're too overvalued. Maybe we should wait, sell and wait for a pullback. But let's look at the data. Thanks to research from Ben Carlson, we know that over the past 10 years, the market has hit 300 all-time highs. In fact, in 9 of the past 10 years, the market has made new highs. Since 1950, about 7% of all trading days have been an all-time high. That means on average, a new high happens every 14 trading days. This chart from JP Morgan shows us that between January 1st of 1988 and August 27th of 2020, so a few years old, but the market's been very bullish since then. If you had invested in the S&P 500 on any given day, your average total return a year later would have been just shy of 12%. However, if you only invested on days where the S&P 500 closed at an all-time high, your average total return would have been nearly 15%. So believe it or not, the average returns were better from all-time highs. So am I saying that you should go all in on the S&P 500? No. What you need to do is make sure that your investment portfolio is tested for the long term. If you're approaching retirement or just retired, you need to bucket your money so that you avoid the sequence of returns risk. If you've been retired for years and years, you need a balanced portfolio for income and growth. The bottom line is that you need a portfolio that you can hold, one that allows you to enjoy your retirement with as little financial stress as possible. If you're interested in learning more about our process at URS, click the first link in the description below, and I'll see you next time.